Hello, welcome back. How are you all? On behalf of Dr. Labib's Academy, I'm Dr. Labib is this side. Today we are going to cover financial reporting section B. Okay, and I kindly request you all to see this video till the end, share it, subscribe it, and press bell icon so that whenever I am going to post new videos, you will get notification. Today we are going to cover the section B. Okay, we are going to have section B. We have to reach as many people as possible who are aspiring to become ACCAs. Fine. Now, this is section B, scenario-based question. The direct what it says, there are two scenarios has been given. Based on those two scenarios, we have to answer the questions related to that. The directors of BTunshill company are disappointed to the draft profit for the year 30th September. The company assistant accountant has suggested two areas where she believes to report profit may be improved. Okay, a major item of plant costing how much? 20 million was purchased, installed on 1st of October. How much is there? 1st of October. How much they have? 1st of October. How much they have installed? It is for how many million? 20 million. It is how much? 20 million. They are using the straight line method of depreciation. And what is the life? Life is going to be 5 years. Okay, life is going to be, no, residual value is nothing, 0. Residual value is how much? Residual value is 0. The plant is wearing well and the beginning of the current year. See, the projection believe that the plant was likely to last for 8 years. Fine. They are changing, they are revising the life. Revise the life. It how many years? See, as simple as that. What will happen when you increase the life depreciation amount? Is that life is increased? Is that depreciation amount will decrease? Profits will increase. Okay, profits will increase. This is the way we have to change the profits. Fine. They are likely to last for 8 years in total. The assistant accountant has calculated that based on the 8-year life, is it based on the 8 years life has no residual value, the accumulated depreciation of the plant would be how much? 7.5 million. Is it 20 divided by 8 into 3 years? Is it as on 31st of October 2002? In the financial year ended 30th December 2002, the accumulated depreciation is how much? They have calculated accumulated depreciation at the rate of 8 million. See the thing. See, if they are, it is for 5 years. It is for 5 years. What happened? 20 divided by 5 into 2. Is it right? Into 2. How much is there? It is 8 million. If it is for 8 years, is it right? It is for 8 years. 20 divided by 8 into including the current year. Is that including the current year? 3 years. Is right? This is what? Including current year. Okay, including current year. Don't get confused. 20 divided by 8 into 3, it comes to 7.5 million. Okay, it comes to how much? 7. Therefore, by adopting an 8-year, BTunshill can avoid depreciation charge for the current year. Current year will be how much? It will be only 0.5 credit, not debit. Okay, it will be credit, not debit. Means you are saving the depreciation for the current year, and to profit and loss account in the current year to improve the reported profit. Fine. A very interesting one. Very interesting. We can learn the concepts here very specifically. Next, most of the BTunshill competitors value their inventory using the average cost, whereas BTunshill uses first in first out method. Fine. Make it a point. It's very another interesting. You have option 1. You have option 2. Okay. You have sales. Assume sales is going to be 30,000. Okay. Assume this is only an assumption. Okay, this is on that. Just I'm explaining just because you should have a clarity about how the thing. Cost of sales, is it right? Cost of sales. Now they are using the FIFO method. The value of Tunshill inventory is going to be how much? On the basis of FIFO is how much? 20 million. However, average cost basis is going to be 8. Assume cost of sales is going to be 20,000. Okay, here the cost of sales is going to be 18,000. How much is the gross profit? Gross profit here it is going to be 10,000. Here it is going to be 12,000. Means here also there is a possibility that we can increase the profits. Is it? There is a possibility that we can, if we are using FIFO basis, is it right? If you are going to use FIFO basis, this is the profit. If you are using average cost basis, profits will have automatically profits will increase by how much? Profit will increase by 2,000. Is it? That the assistant accountant said that the company will improve the profits by the year end by how much? 2 million. Tunshill inventory on September 2000 is how much? The closing inventory is 15 million. Here the closing inventory is 13.4 million. Fine. We will cover that. What is the nature of the change policy proposed? What is the nature of the change being proposed by the assistant accountant in option 1? Okay, in option 1 and should be applied. What happens when we are talking in terms of option 1? Is it right? When we are talking in terms of option 1, it is not, see what happened, we are changing, it is not changing the policy. We are not changing the method. What we are doing? We are changing the estimates. Fine. We are changing the estimates as such. That's what that is there we are very much concerned about. Fine. We are changing what? We are changing the estimates. We are not changing the policy as such. Retrospect. We are not talking about the policy. Is it? We are not talking about the policy. Here also we are not talking about the policy. We are changing the estimates. Fine. Now we are changing the estimates not from the previous year. We are changing the estimates from the future. Already what happened? 1/10/2000. Is it at 1/10/2001? 1/10/2002. Is it? Already how many years have been happened? 2 years. They are not doing anything else. They are not doing anything for the past years. They are past years. What they are doing? They are taking into consideration for what? They are taking into consideration for future years. Future years, what happened? From the previously past years, how much? 5 years. Now how many years are they? They have revised it for 8 years. Now already 2 years has been passed. Means for the next 6 years. If they are talking about the next 6 years, is it right? It is not retrospective means previous. We are not talking about a retrospective. We are talking in terms of what? Retrospective means previous. Is it? Retrospective means change of accounting estimates. Is a change of accounting prospective. Prospective means future. Is it? Change of the accounting estimates for the next. When we say prospective, it is for the next remaining. Is it? Next remaining 6 years. Is it? Next remaining 6 years. Fine. Okay. Adjusting for the change of useful life. What will be the carrying amount as on to the means what see the things. How much is there? It is 1/10/2000, 2001, 2002 and 2003. Is it right? This is 1 year, 2 years, 3. Means we have to take into consideration for how many years? We have to calculate for 3 years. Fine. Now, how much is the original cost? Original cost is how much? Original cost is going to be 20 million. Fine. Now, already depreciation, 2 years depreciation. Is a 2 year depreciation. How they have calculated? 20 million. Is it 20 million divided by 5 years into 2 years? Is it? How much is the if you take into consideration 8 million, fine, 8 million, how much is there? It comes to 12 million, is it? This is the carrying amount, fine, this is the carrying amount as on 1/1/2002, is it? Now current year depreciation, is it? Current year depreciation is how much? 12 million divided by how many years? 6 years. Remaining is how much? 6 years. It comes to how much? 2 million. Fine. It comes to, means what is the carrying amount? It is carrying amount is going to be how much? 10 million. Is it? Carrying amount is going to be how much? Carrying amount is 10. You got the things? First you have to take 20 million. For 2 years we have to, already we have done, it is not retrospective, it is prospective. 8 million, carrying amount is 12 million, and from 12 million we will take for next 6 years each year. This is based on what? This is based on straight line method. Fine. The answer is how much? The answer is, which of the following would be treated as a change in accounting policy? What is the accounting policy and what is the accounting estimate? BTunshill has received its first government grant and is applied the deferred accounting method. They have received government grant. Is it right? They have received government grant. Government grant is applying deferred method. Is it? The method is, it applies as per the deferred income method. BTunshill has changed the rate of depreciation used for its office equipment. It is what happened again. It is going to be a estimates. Is it right? It is going to be an estimates. They are talking about the 10% to 12%. It is going to be a estimates. BTunshill has reclassified. Is it? Reclassified development cost from other expenses to cost of sales. Is it? When you are reclassifying, you are changing the policy. Is it right? This is related to what? This is related to accounting policy. Yeah. We are making a recalculation. Fine. If it is for related to numbers, it is estimates. Okay. Either in terms of percentage, either in terms of years, or whatever it may be. Fine. The answer is what? The answer is BTunshill has reclassified development cost from operating expenses to cost of sales. Fine. What will be the effect of change in 2 on profits for the year ended 31st 2003? Is it? What is the change of profits? That's what we are talking about. Now what happens? They are changing from first in first out method to, they are changing from first in first out FIFO to average cost. Is that they are changing from FIFO to average cost. We have to do some little bit calculations. Is that particulars? You have FIFO, you have average cost. Is it? You have the current year profits. How much is they? Just go through it. How much is they have given the closing inventory also? Is it? Third closing inventory 15 million and 13.4. Is it right? 15 million. Is it closing inventory? Yeah, closing inventory. Closing inventory is how much? Closing inventory is 30th September. 30th September. How much is there? 1 minute. The 2002, is it? 30th September 2002 is how much? 15 and 13.4. Fine. 15 and 13.4. And they are saying that, see, now they have given two things. Is it? They gave a closing inventory on 30th September 2002 and they gave a closing inventory on 30th September 2003. Both the FIFO method as well as on the average cost basis. All existing is what? Existing is FIFO. Is it right? Now they are changing it to average cost basis. Fine. Here also what FIFO is 20 million, average cost is how much? 18 million. Is it? FIFO is how much? 20 million, average cost. Is it? FIFO is this is 2002. Is it? 2000. FIFO is how much? 15 million. Average cost is how much? 13.4. Difference is, see, the inventory value is decreasing. Is it? The inventory value is how much? 1.6. It is in millions. Fine. Now, what happens? You have again, is it? You have again on closing inventory when it is there. It is on 30th/9/2003. How much is there? 20 million is as per FIFO and 18 million as per LIFO. Okay. 20 million as per FIFO, 18. How much is the difference? It is going to be 2. Okay, it is going to be now. What is the difference? Difference is going difference. I'm not. Is a difference. I'm writing very clearly. Difference is 0.4. Okay, 0.4. Yeah, difference is 0.4. What will happen? It is a difference. Because of difference, it is a negative difference. It will have impact on what? It will have impact on. It will reduce current year profits. How much it will reduce current year profits? It will reduce current year profits by how much? It will reduce by 400,000. Yeah? It will reduce by, difference is how much? Difference is minus. Answer is how much? Answer is reduced by how much? Reduced by 400. Using the drag and drop options, select current account. Select the correct account to show the accounting entry for change in inventory value for the year. Yeah, what happening? Your inventory is decreasing. Is it an asset? Is it? Inventory is an asset. When asset decreases, it has to be credited. Is it? When the asset will decrease, it will have to be credited. What we have to do? We have to do what? We have to do inventory. Credit will be inventory. Is it? Credit will be inventory. It reduces the value of the asset. Now, it is there. It is some way. It has been given as a cost of sales. Yeah. We are taking into consideration the gross profit. Is that what is the which is the direct account? It will not impact revenue. It will impact what? It will impact cost of sales. Right? It will impact cost of sales. This is the way we have to make sure that a basic conceptual question with respect to the non-current assets, change in the life of the asset, and the change in the value, then in the method of valuation. Is it right? Change in the method of valuation. Non-current assets and current assets. Very important one. Just revise this 1 second before we go to the next one. Fine. Now, what is there? They have mentioned another question. Is right? They have mentioned another question. Sandbag PLC. First, you see this is related to what? This is related to financial state. Interpret accounting ratios. Is right? This is related to accounting ratios. They gave you a income statement, balance sheet, statement of financial position. They are asking you current ratio. Is it? They are asking you what current ratio. It's very simple, very straightforward. Current ratio is equal to current asset divided by current liabilities. How much is the current assets you are having? Current assets are having how much? Current assets are 133. Current liabilities are how much? Current liabilities are 103. Is it right? 133 divided by 103. It comes to how much? It comes to 1.29. Is right? It comes to 1.29. Next. Conceptually, it looks at the finance director of Sandbag is worried about its current ratio. He is considering number of actions that he hopes improve current ratio. Fine. Which of the following would increase current ratio? Current ratio is a 2:1. Is it right? Your current assets has to increase. That's very important. Your current assets, how we can increase the current assets? Offer a settlement discounts to customers. Is that when you offer settlement discounts to customers, what will happen? Cash will decrease. Is it right? Cash will decrease. When you are cash will decrease. When cash is decreasing, what will happen? Current ratio will also decreases. Fine. Cash will current. Make a bonus issue. Bonus is no cash movements. Is it right? You have no cash movements. What will happen? Only the equity shares will increase. The number of equity shares will increase. This is the number of equity shares. It doesn't have any impact. No impact on what? No impact on cash. It is also not related. Make a rights issue of ordinary shares. Is it right? Make a rights issue of ordinary shares. Sell current assets investment at a carrying amount. You sell current assets. What will happen? Current, it will remain same. One asset will increase, another asset will increase. Is that the net result? The net result is what? The net result is going to be same. Whereas in terms of make a right issue, what will happen? When share capital, rights issue, you will get share capital will increase and cash will also increases. Is it? Share capital will increase and the cash will also increases. Is it? I'm writing the reasons for every option. What will happen? Is that what is Sandbag quick ratio at 2004? Fine. What is the quick ratio? What is the quick ratio? It is nothing but current assets minus inventory divided by current liabilities. Is it right? How much is the current assets? We have done 133. Is it? Current assets are how much? 133. Inventory is how much? Inventory is 96. Okay. Inventory is how much? Inventory is 96. 133 minus 96. Current liabilities how much? Current liabilities is 103. Is it right? How much you will get? 33 plus 4, 37 by 103. Is that? It comes to how much? It comes to 0.36. 0.36 is to 1. Fine. That's another one. Now, see, this is conceptual question. See the thing. The finance director of Sandbag knows that the acid test ratio is below 1. Is that? It is 0.36 is to 1. Is that? You take the previous answer, previous question answer. Is that? Previous question answer. Now, he is planning two changes. Offering a 2% early settlement discount to credit customers. Delay payment to the all trade payables by 1 extra. Using the option below, match the effect of proposal would have on the acid test ratio. See, acid test ratio is not what we have to increase the cash. Is it? Cash balance has to increase. Marketable securities, receivables, cash, is that compared to payables. Now, if you are what they say, using the options below, match the effect the proposal would have on the acid test ratio. Proposal 1, what will happen? Offering a 2% early discount, is it right? Offering to, what will happen? When you say cash will decrease, what will happen? Your quick ratio will also decreases. Is it? Quick ratio will also decreases. What will happen if you take the option 1? The quick ratio will decrease. Delay payment, if you are delaying payment, what will happen? Delaying payment, when you delay payment, definitely cash balance, is it? Cash balance will remain same, or the proportionately the cash balance. See, you are getting the advantage of 1 month, is it right? You are getting the advantage of what cash balance will increase. When the cash balance will increase, quick ratio will also increase. What will happen? The first statement will decrease the ratio. The second statement will increase the ratio as such. Okay. Now, Sandbag is a manufacturing company. Okay. It has been given in the beginning. It has been given in the first sentence. Sandbag is a listed manufacturing company. Sandbag is a listed manufacturing company. Which of the following would best assess the efficiency of the Sandbag? Yeah, when it is a manufacturing companies, what manufacturing companies are mostly dominated, influenced by what? Non-current assets. You will see the things, non-current assets, manufacturing. For them, the lifeline is the non-current assets. Yeah, price gearing ratio is price earning ratio is what you are investing on, you are expecting. Gearing ratio is what? Debt divided by debt plus equity. Debt plus equity. Non-current assets. Current ratio talked about what? Current asset ratio talks about liquidity. Gearing ratio, it talks about the leverage. It talks about the leverage. Price earning ratio, it talks about the investment ratios. Fine. The answer is what? The answer is non-current assets. The answer is not. See, this is the way they will mention, this is the way they will structure the things. Okay. It looks simple, but it really, you should have a complete understanding about the basic concepts. They are not just asking about the calculation. They are talking about this is called as a logic. What is the reason and what is the result? What is the cause and what is the effect as such? It makes really things to be done in the understand the specific way. This we have done in the last session. I have done this one. Okay. You can refer my last video as such. Fine. Now, what it says, we'll do this also. Okay, we'll do this also. Yeah, make it a point. Just to go through the things. The following scenario relates to on April 1st. Polestar acquired how much? 75% of 12,050,000. Means how many? 6 million shares. Is it right? 6 million shares of South Star at an immediate cash payment of 1.5 per share. The statement of profit and for the year ending 30th September 2003 show revenue for Polestar and South Star as 10 million and 16 million respectively. Revenue recorded evenly over the year. Fine. Is it revenue recorded evenly over? At the date of acquisition, what is the fair value? It is related to what? It is related to the parent company and the subsidiary company. Fine. It is related to the parent company. Very specific in the examination. You will have instantly. You will have 15 questions in section A and 15 questions in section B. Is it? They will entirely go in a different concept. Okay. At the date of acquisition, fair value of the South Star subsidiary assets are carrying amount with the exception of right of use property and the lease agreement. How much is the fair value? 2 million above its carrying amount, and the remaining lease is how much? 10 years as there. All depreciation is included in cost of sales. Okay, fine. In most of the time, you will come across the sales to be included in cost of sales. What they say? The fair value is 2 million above the carrying amount, and the lease period is 10 years. Fine. This is sub-scenario 1. Contingent consideration is how much? 1.8 million. Contingent, okay. But by 2003, due to continuous losses, its value is estimated what? 1.5 million. 1.5 million. Means contingent consideration, they say that it will be 1.8 million. But what happened by 30th September, after 6 months, the value is estimated only 1.5. The account has not been recorded by the Polestar, and directors expect the acquisition to be a bargain purchase. Just go through my lectures. In that lectures, I gave you a complete explanation about the bargain purchase. Fine, we'll take that. Polestar sold materials to at the cost of 4 million to Southstar in 2003. They purchased, processed all these materials at an additional cost of 1.4 and sold them. That is, it is by 9. It is nothing but intercompany transactions. Is it right? Intercompany transactions. We have to eliminate these intercompany transactions. 4 million and 9 million. Okay. At 30th September, Polestar has 1.5 million of these goods still in the inventory. There are no other intra-group sales. Fine. It is having 1.5 is the goods not sold. Is it? Profit, unrealized profit, portion of unrealized profit, PURP. Okay. PURP. The moment you say it is still not goods sold, what is that? They have not given the price, all these things, is it? Polestar policy is to value the NCI at a fair value. That's a normal procedure. Southstar's share price is how much? 1.2 per share, and deemed to be representative of the fair value of the shares held by NCI. The retained earnings at the date of acquisition is how much? 114.3 million. Is that 14.3 million? Okay. They gave you a good substantial information for us to think about. Okay, to think about a lot of information. Now, what is the fair value? Focus on what is the fair value of the net assets at that acquisition date. They have some. What is the fair value? What is the fair value when you take the things into consideration? Is it right? When that what they have mentioned it how much. They have mentioned the share capital. Is it 50 cents? Is that share capital? How much is the share capital? Share capital is 12 million. Is it 12 million divided by 0.5 cents? Is it right? Cents? It comes to how much? It comes to how much? It comes to 6 million. Okay, it comes to 6 million. They have, okay, fine. That's they say that here it has been mentioned. How much is there? The retained earnings. What we have to do in the fair value? We have to take the retained earnings out at the date of acquisition. How much is there? 14.3. Is it? Retained earnings at acquisition. Is it right? Retained earnings at acquisition. How much is there? It is 14.3 million. It is how much? It is 14.3 million. Next, they have mentioned that the fair value of an asset is above its carrying amount. Is it? The fair value of the asset is it's a fair value. Is it? Fair value of one asset. Is it? Asset is it how much? It is going to be how much? 2 million. Fine. It is how much? 2 million. That's all. There nothing is there. Fair value of the proper fair value of the lease term, and they are talking in terms of the retained earnings and share capital. How much is there? 14 plus 620, 22.3 million. Is it right? 22.3 million. What is the consolidated revenue? Okay, consolidated revenue. How much is the consolidated revenue? Again, we have to, what is the parent revenue? What is the parent revenue? 110. Is it right? What is the parent revenue? 110. How much is for the subsidiary? It is how much? 66 million. Fine, 66 million. Now you see the things. You see the reason, is that when they have, see, this is on April 1st Polestar acquired, and the statement of profit and loss account is how much? On September 30th September, 6 months. Fine, is that I will write there. This is very, very crucial for us. Students will really, they will not see. The first you have to see date of acquisition and the information given. Is that we have to take the proportionate amount only. Means 66 million, half of 66 million. Is that half of 66 million we have to take? Is that Polestar is how much? Polestar is how much? Polestar is 110 million. Fine. Next, what is the South Star? South Star is how much? South Star is how much? 66 into 6 by 12, 6 months. Okay, is 66 into 6 by 12. How much we'll get? We'll get 33 million. Fine. From this we have to take into consideration the intergroup. Is it right? How much is the intergroup? Intergroup is how much? 1 minute. We are talking about this one. Yes, fine. This is one. Fine. This is South Star purchase material sale. Sold them back at the things. Is it? They one. Company is how much? Non-controlling interest of 4.3. The intergroup transaction is how much? They sold materials at cost 4 million on June 30th. South Star processed 1.4 million. Is that 1.4 million? And fine, we are not taking the processing cost, and sold them back to how much? 9 million. Fine. How much is the intergroup transactions? Intergroup transactions is how much? Intergroup is how much? Intergroup is 13 million. Is it right? 9 plus 4. Is it right? 9 plus 4. It comes to how much? 130, 110, 143, 143 minus 13. It comes to 130 million. It comes to how much? 130 million. Okay. Due to lower than expected profits of the acquired company, South Star, the estimated value of the contingent consideration fallen from 1.8 to 1.5. Is it right? 1.82. See what happened? The contingent liability, is it? If the liability decreases, what we have to do? Which account it has to be debited or credited? It has to be debited, because liability is a credit account. To increase the liability, credit it. To decrease the liability, you have to credit it. Debit what? Debit the liability account. And credit what? Definitely, is it? Credit will be what? See, your liability increases means automatically it will have impact on what? It will have impact on profit and loss account. It will have impact on profit and loss account. Okay. Now, what is the amount of adjustment to profit attributable to NCI in respect of unrealized profit? Is that unrealized profit? How much is the unrealized profit? Unrealized, I will write little bit. Is that? I will write from here. What is the unrealized profit? That unrealized profit is how much? How much they have taken? They have 9 million. How much is the process? 9 million. Fine. 9 million. What is the processing cost? Processing cost is how much? Processing cost is 4 million plus 1.4 million. Fine. Processing cost is 4 million plus 1. What is the? It comes to how much? It comes to 9 million minus 5.6 million. Is it 9 million minus, sorry, it is not 5.4 million. It comes to how much? 3.6 million. Is right? How much is it is still in the inventory is how much? 1.5. Is it right? 1.5. See, is it right? This is the unrealized profit. Is it right? Still in inventory how much? Still in inventory. Is it right? This is the unrealized profit. Unrealized profit. Unrealized profit. Is it unrealized profit? Unrealized profit times, is it unrealized profit still in inventory? Just I am writing in my own words, okay, just to make you explanation. In times what is the total value of, is it, how much is there? How much is there? They have sold them back is how much? 9 million. Fine. How much is there? Sold back. Sold back how much? 9 million. Is it 3.6 times 1.5 times 9 million. Okay, 3.6 times 3.6 times 1.5 over 9. .6 times 1.5 divided by 9. 3.6 into 1.5 divided by 9. How much will get? You will get 0.6 million or 600. Okay, 600. Now, how much they say? How much they are going to say? They are saying that 25%. Is it? They say what is the percentage of NCI? Percentage of NCI subsidiary is how much? 25. The percentage, how much will come? It comes to 150. This is the percentage of the subsidiary. 0.75 is to 0.25. It comes to how much? It comes to 150,000. Is that? It comes to 150,000. Okay. Now, PV clear. This is, don't get confused. This is nothing but this is the percentage of the South Star. Okay. Percentage of the South Star. This is the NCI. 0.25. Polestar measures the NCI in South Star at fair value. Which of the following applies when NCI interest is measured at fair value? Is it? The NCI will be allocated its share of any negative goodwill. The NCI will be allocated its share of any negative goodwill. The NCI will be allocated the whole of, no, we cannot say it is a whole of pre-acquisition profit. Control is which of the following applies? Is it? Which of the following applies? It's the fair value. Is it right? It is about the fair value. Fair value is where in terms of the assets. Is it right? In terms of the assets. The NCI will be allocated its share of any goodwill impairment. If there is impairment, what my point? Now, if there is any impairment, that impairment will be shared by the parent company and the subsidiary company. Okay, that is where we are. If you go through the consolidated financial statements, if there is any impairment, the goodwill, if there is the impairment value will be allocated to both the goodwill as well as to the NCI. If subsidiary share falls, the NCI con will be adjusted. Hardly will come across this type of a situation. Fine. The answer is what? The answer is the non-control NCI will be allocated its share on the impairment goodwill. Okay. These are the 3 questions we have done today. Fine. 3 scenario based questions. How much time it has taken? 45 minutes. 15 minutes. Okay. 15 minutes with explanation. But if you do it in examination, it will be taken how many, if you take into consideration how many marks are there? 30 marks. Fine. 30 into 1.8. It comes to how much? 54 minutes. Is it 30 into 1.8. Each mark is for 1.8. Fine. This is the way we have to go. Okay. And hopefully when we are coming back next, we are going to have something on cash flow statement. Fine. Share it, subscribe it, and press the bell icon so that the notifications will be you will get a notification the moment I am going to post the videos. Thank you so much. Take care.